Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I want to highlight 5 of my favorite REITs to buy for July of 2025. I've been accumulating more shares of these specific REITs over the last few weeks, and I plan to keep buying more of them in July. So let's get straight into it. The first REIT I want to discuss here is called Kite Realty Group, ticker symbol KRG. This is a retail REIT that owns primarily grocery-anchored, necessity and service-oriented strip centers, mostly in the rapidly growing Sunbelt markets, but also in select coastal markets. And the reason why I like these properties so much, not just the properties of these specific REITs, but this entire property sector, is because these type of assets are undersupplied in today's market. We haven't had much new construction over the past 10 years. This is because prior to that, this property sector was oversupplied. Many developers lost a lot of money, and as a result, we didn't have much supply of the last 10 years. The market sentiment for retail in general was very low due to fears of how e-commerce might affect these properties over the long term. But as a result of this, now this property sector is severely undersupplied, and we're seeing steady 3 to 5% same property NOI growth across the board, very high occupancy rates. This has really turned into one of the best performing property sectors of commercial real estate, which, you would have told me 5 to 10 years ago, I would have been surprised. And just recently, I saw a very interesting study that said that we would need to see rents rise by 65% on average to make new development projects economically feasible. And that's because rent levels remain quite low relative to the construction cost of these properties. And so what this tells us is that we're likely to see steady growth in same property NOI for a long time to come, because again, development projects remain uneconomical at the current rent levels, and this is why the property sector is undersupplied. And so why do I like Kite Realty specifically? There are a few reasons, but it really boils down to its valuation. It's today priced at 11 times its FFO at an estimated 25 to 30% discount to its NAV. That's a much lower valuation than most of its close peers, and I don't think that this makes sense given that Kite Realty actually has a better balance sheet than most of its peers. It has the least leverage in its entire peer group with a debt to EBITDA of below 5 times. I'll put a chart on the screen comparing its leverage to that of some close peers like Regency Centers, Kimco Realty, Federal Realty Trust, and many others. But it's not just that. In addition to having a better balance sheet, Kite has also experienced some of the fastest rent growth in the recent years in its peer group. It has enjoyed some of the biggest releasing spreads, and I think that this is because many of its leases are deeply below market. This happens often when a REIT signs long-term leases, let's say a 10-year long lease with a tenant with annual rent escalations of, let's say, 2%, but rent grows faster than this, and as a result of that, often you'll have leases fall below market level. And so this is now providing the REIT a great opportunity to gradually bump up its rents as leases expire. And so it's enjoying some of the fastest rent growth despite having one of the lowest leverage in its peer group, and yet it's trading at one of the lowest valuations. So I think this is a great opportunity. And here you might wonder, why is it priced at a discount to its peers? And I think that this is because most of the market is very short-term oriented. Most investors, as you know, they're focusing on the next quarter, not on the next 5 to 10 years. And if you are short-term oriented, then this discount might make sense because Kite is expected to suffer more tenant bad debt in 2025 than most of its peers. It's a bit more heavily exposed to some of the recent retail tenant bankruptcies, but ultimately the impact is not significant. The company is not going to enjoy much, if any, growth in 2025. Its FFO per share has been guided to be roughly flat, but as it then gets back its vacancy space, redevelops it, releases it to better tenants at likely much higher rents, given how strongly this property sector is today performing, I think that we're going to see a nice acceleration in growth already in 2026, 2027. And with that, we likely also see some FFO multiple expansion. So all in all, here you're getting a roughly 5% dividend yield. The company is expected to keep growing its FFO per share and creating value at a rate of about 6 to 8% per year over the long run. Those two alone should get you to double-digit total returns. Add to that some upside from multiple expansion, the NAV discount closing down, and I think that you have a very attractive investment story. So for this reason, we've recently doubled down on Kite Realty Group at High Yield Landlord. By the way, if you want to access all our trade alerts in real time, as well as our full portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. Now, the second REIT I'm going to discuss is actually a close peer of Kite Realty Group. I just mentioned it earlier. It's called Kimco Realty, ticker symbol KIM. The story is very similar to that of Kite Realty Group in that it's focusing on similar properties that are doing today very well, enjoying steady 3 to 5% same property NOI growth, which is one of the best growth rates across commercial real estate sectors today. But Kimco, the story is a bit different in that it's a bit of a safer bet with perhaps a bit less upside potential. And the reason for this is because this is a much bigger REIT. I don't remember the market cap from the top of my head, but it's over 10 billion. This is a very big REIT, much bigger than Kite Realty. So better diversified, larger economies of scale, better resources. It has a better investment grade rating as well, in big part because of this large scale. It has a triple B plus investment grade rating. I think from one of the rating agencies, it even has an A minus rating, whereas Kite Realty is at just triple B, which is also quite good. It's also an investment grade rating, but you see here that Kimco has an even stronger balance sheet. It has a bit more leverage in terms of debt to EBITDA, but its debt maturities are better staggered. It has better access to liquidity and so on, better investment grade rating, as I mentioned. And I think that its asset quality is slightly superior to that of Kite Realty. The difference is not significant, but again, that makes it somewhat safer, and yet it's also discounted. Just like Kite Realty, for the same reason, it's experiencing a bit of bad debt in 2025, which is slowing down its growth. But I think that as growth accelerates in 2026, 2027, we're going to see a re-rating of its multiple to a higher level. And so the story is similar. It's trading at about 12 times FFO, 20% discount to NAV, so slight premium to Kite Realty, but still a very attractive valuation. And so that's why I like it so much. I think that with the yield, the growth, so multiple expansion, the REIT is likely to do well over the coming years. This is, in my opinion, a resilient sector that should do quite well in a recession because people need to eat. They will still go to the grocery store. They will still go get their haircut or whatever other services are offered at these strip centers, these neighborhood community centers. So I really like the risk to reward of Kimco as well. The third REIT, before I go to the third REIT, can you please do me a huge favor and click the like button, subscribe to the channel. It helps me a lot to keep growing this channel. As you can see, I'm traveling once again and I'm still trying to put this free content for you on YouTube, so I really appreciate it. Thanks so much in advance. The third REIT that I want to highlight is called Vesta REIT. This is, I think, the only foreign REIT of the list today that I'm going to discuss. This is my biggest investment in Mexico. It's an industrial REIT that owns a lot of properties that I think will significantly benefit from the growing trend of nearshoring. But despite that, the valuation is quite low today, in big part because of the fear of how the trade war, the tariffs could impact Mexico and the trend of nearshoring. The market seems to think that it's going to hurt the prospect of Mexican industrial real estate. I think it's the opposite. I think that this trade war is going to have a much bigger negative impact on countries like China and also other Southeastern Asian countries, because I expect them to be hit with bigger tariffs than Mexico. So relatively speaking, I think it's going to make Mexico even more attractive for nearshoring. And some people might think that's going to bring a boom in new domestic manufacturing in the US. I'm a bit more skeptical because cost difference is still really big. Companies also are reluctant to make such big changes given that tariff rates keep changing from one week to another. So I think that the more realistic outcome is that more and more companies are going to want to diversify away from countries like China specifically, because China has been especially hard hit by tariffs. They've been targeted by Trump specifically, and companies will bring closer to their domestic market their manufacturing. So countries like Mexico, and that's going to lead to a significant boost in demand for industrial space there. And Vesta is one of the leading REITs there that owns a very high quality portfolio. It's already working with a lot of big American companies like Amazon, Home Depot, Walmart, and so on. And it has a big land bank that's now in the process of developing, earning very high returns on its development projects with initial yields of 9 to 11% in most cases. That represents a big premium, a big spread, relative to its cost of capital as well. And given that the company expects this growth to continue, it has guided to grow its FFO per share by 10% annually through 2030. This is one of the highest growth rates of any REITs that I know of. The REIT also has a low LTV of just around 20%, so strong balance sheet. It's in a great position to keep funding these new development projects with new debt. But despite that, the multiple is very attractive. It's trading at just around 12 times FFO. The company has been buying back shares even. And so again, you have very attractive growth story with secular long-term trend benefiting the REIT, despite that it's trading at a low valuation, a steep discount relative to its IPO price. This is one of the only Mexican REITs also listed in the US on the Nasdaq, which makes it easier for investors to buy it. The only downside is that the yield is quite low at around 3% because the REIT is retaining most of its cash flow to reinvest in growth. Some investors don't like this. I think it's actually a benefit for us because the the REIT has great investment opportunities. I prefer them to retain this cash, reinvest it to grow the value of the company. It's more tax efficient for us as investors. Remember, this is a Mexican REIT, so there's a withholding tax on the dividend. The impact is not significant. In my case, there's no impact at all because I can use it as a tax credit in my home country. But in any case, it's still more tax efficient if they retain this cash flow and reinvest it themselves in high yielding development projects. So I think it's a positive. Overall, even with a 3% dividend yield, 10% annual growth, you get to 13% annual economic returns, even without including any multiple expansion, which I think we will also get in the coming years once the dust settles and people, stop talking so much about the trade war. Fourth REIT is actually not officially structured as a REIT, but it's essentially functioning as if it was one. It's called RCI Hospitality, ticker symbol RICK. At one point, this was my biggest position. I bought a lot of it early in the pandemic when I traded in the $10 to $20 range. Back then, the company was facing very severe headwinds because this is the only nightclub investment company that's publicly listed. It's focusing a lot on adult nightclubs, to be more specific, and it often buys the real estate with the clubs, given that the license is tied to the real estate. So it's essentially working as if it was a hotel REIT in a way. It's in the hospitality space. It's buying the real estate and operating it itself, but it's not officially structured as REIT. It faced significant headwinds during the pandemic, as I said earlier, but it was a pandemic recovery play initially for me. As we recovered from the pandemic, it rose all the way to $100 almost, but since then it has dropped back down to $40. And as a result of this drop, it's not my biggest holding anymore, but still one of my top holdings, and I plan to buy more of it potentially in July because the latest news has been quite positive in my opinion. Most importantly, it has now returned to new club acquisitions. It has already acquired 3 clubs this year. And the very attractive things about these club acquisitions is that the company is able to get them at very low earnings multiples. This is one of those spaces where you have many sellers because a lot of owners are approaching retirement age, but this is not the type of assets that you pass as a legacy to the next generation. At the same time, there are not many buyers because if you're a local successful business owner, your wife or husband probably doesn't want you to buy the local nightclub. If you're a small investment fund, you probably have some limited partners who don't want you to get involved in this line of business either. If you're a public company, you have this whole ESG thing also. You have a lot of ESG driven funds that would sell your stock if you get into this business. And so as a result, there's just no natural buyers for these assets. And REIT is the only publicly listed consolidator in this space. And so it's the natural buyer for a lot of these sellers. It's able to get these quasi-monopolistic assets at 3 to 5 times EBITDA, representing very significant spreads over its cost of capital, much larger spreads than what typical REITs get when they are buying assets in more crowded markets like multifamily, industrial, you name it. And so because of these larger spreads, REIT has been very successful ever since it started consolidating this space, ever since it changed its capital allocation strategy in 2016 and started to consolidate this space. And so because of this, REIT has been very rewarding to its shareholders ever since it changed its capital allocation strategy in 2016 to refocus on consolidating these clubs, earning large spreads of its cost of capital, massively outperformed the rest of the market. And I think that after now seeing its share price drop back to much lower levels and its valuation multiple contract to now trading at just around 6.5 times its free cash flow, I think that we're now going to see a re-acceleration in its growth in the coming years as it returns to club acquisitions. And with that, we could see significant upside. So for this reason, I haven't lost track of the long-term thesis of consolidating this fragmented space, earning high spread of its cost of capital, expected to create a lot of value for shareholders. The reason why it dropped so much in recent years is because we went through a post-COVID normalization period. In 2021-2022, REIT did extremely well because of the reopening. People wanted to have fun, go out. They were not able to travel internationally yet, so a lot of people were traveling to places like New York, Miami, where REIT is heavily invested. This led to unusually strong club performance, but then in 2023, 2024, this performance returned back closer to normal, and so we had negative comps. The market didn't like that. On top of that, REIT wasn't able to buy new clubs because sellers were basing their valuations on those peak years of 2021, 2022, and so because of that, it did so poorly poorly in recent years, but I think that this will soon become a distant memory now as the club performance stabilizes and they clearly return to acquisitions as they've done in 2025 with already 3 acquisitions and likely many more to come. Fifth and final REIT I want to discuss here is also operating in a sin industry. This is the cannabis REIT called New Lake Capital Partners. I've mentioned it quite a few times on this channel, but I think that now specifically could be an interesting time to buy more of it because share price has come back down to a multi-year low. It's trading at about $14 per share. That's representing about 6.5 times FFO, a 12.2% dividend yield, an estimated 35 to 40% discount to NAV. Very attractive level. Historically, whenever the stock has been so cheap, the management has been quite aggressive with buybacks, and I expect them to be once again this time, given that they are retaining nearly 20% of their cash flow, which they can use to fund buyback those shares. The reason why it's so cheap is obviously because the cannabis space is tough. A lot of their tenants, the operators, are suffering, they're barely profitable or even losing money, and so the market worries that we could see growing lease defaults going forward. I'm not one to tell you that we won't see lease defaults. I think it's very likely that we will keep seeing them in the coming quarters. This is the nature of this business. You're buying properties at 12 to 15% cap rates. You're not getting those high cap rates because the tenants are perfectly safe. It's because it's expected that you will have some defaults. And so yes, you're going to have some, but ultimately I think that the rate will still be just fine, and investors have significant margin of safety buying in at just about 6.5 times FFO. The REIT has no leverage whatsoever. Even if, let's say, they had to cut their rents across the board at 20%, even then the REIT will still trade at below 10 times FFO. The REIT has dividend payout ratio that's historically low. Their targeted range is 80 to 90%. I think that they're about 82% right now, which would indicate that they're likely to hike the dividend later this year unless they face a major lease default, but even then they're likely to not have to rush to cut the dividend. Their leases also include across the board nearly 3% annual rent escalation, so this provides some additional room for a margin of safety that could compensate for occasional lease defaults. Historically, the REIT has been able to find good resolutions whenever some of their tenants were having difficult times paying rent, often reducing the rent slightly, but in exchange getting better lease terms, perhaps a longer term or higher rent escalations down the line. I think that they're going to be able to find solutions once again to whatever tenant difficulty they face in the coming quarters. So I think that this is more than priced in. I've talked to the CEO of New Lake a few times. We've had him for exclusive interviews at High Yield Landlord, and those have made me very comfortable about the REIT. And if you want to read those, by the way, you can access them also with the 2-week free trial that I mentioned earlier. And also it helps to be patient when you're getting paid a 12.2% dividend yield. The company is also buying back shares on top of that. Once again, no debt at all, which is unique for REIT. I mean, it's one of those higher risk, higher reward type of REITs, but I like it as part of a well-diversified portfolio. Today it represents 3.8% of our core portfolio at High Yield Landlord. So, we are well diversified. Even if the REIT faced significant issues, this wouldn't sunk down our entire portfolio. If you thought this video was enjoyable and useful to you, please consider clicking the like button. It helps me a lot. Let me know in the comment section below what other REITs you would like me to give you an update next. And I read all your comments. I really appreciate your support. Thank you. See you on my next one. Bye-bye.